At first glance, the global oil story for 2026 did not look like a crisis. Supply was expected to grow, inventories were substantial, and many forecasts assumed the market could absorb routine volatility. Then, the focus snapped back to a basic vulnerability. A large share of the world's oil still moves through a handful of narrow waterways. That is why a regional conflict can suddenly become a global economic story, even when production capacity on paper looks adequate. The hard facts are more nuanced than the loudest headlines. The IEA said in March 2026 that the oil market is dealing with war-related disruptions in the Middle East, and it singled out the duration of shipping problems through the Strait of Hormuz as the key variable. The EIA estimates that about 20.9 million barrels per day moved through Hormuz in the first half of 2025, equal to roughly 20% of global petroleum liquids consumption, and about a quarter of maritime traded oil. At the same time, global observed oil stocks were above 8.2 billion barrels, which means the market is exposed, but not empty-handed. Oil traders do not wait for gas stations to run dry before repricing risk. If ships may be delayed, insurers may raise premiums, and refiners may have to bid for replacement cargoes. Futures move almost instantly because time matters as much as volume. That helps explain why a market with inventory buffers can still behave like it is under siege. Prices are not only tracking current supply, they are pricing the odds that logistics, shipping, and confidence start failing together. This is where the global oil landscape becomes more interesting than a simple shortage narrative. In February, the IEA still expected world oil supply to rise to 108.6 million barrels per day in 2026, with growth split between non-OPEC Plus and OPEC Plus producers. But extra barrels are not the same thing as instantly deliverable barrels, especially when a choke point is threatened and replacement routes are longer, more expensive, or operationally constrained. The market's real weakness is not just how much oil exists, but how dependent trade flows remain on narrow corridors and precise timing. The first pain does not fall evenly. According to the EIA, 74% of Hormuz crude and condensate flows went to China, India, Japan, and South Korea combined, which makes Asia especially exposed to sustained disruption there. The Malacca route matters too. About 23.2 million barrels per day moved through it in the first half of 2025, and China alone accounted for 48% of import volumes passing through that choke point. That means the countries driving a large share of future oil demand growth are also among the most vulnerable to shipping instability. If the disruption lasts, the damage spreads far beyond crude benchmarks. Higher tanker costs and delayed cargoes can raise refinery input costs, which filter into diesel, jet fuel, freight, and eventually consumer prices. That is part of why the IEA cut its 2026 global oil demand growth forecast by 210,000 barrels per day to 640,000 barrels per day in March, citing higher prices and a weaker economic outlook. The story stops being about oil traders alone when expensive energy starts changing demand, inflation expectations, and central bank calculations. If you want to track this story without getting lost in every headline, watch 4 signals. First, whether Hormuz shipping delays last for days or stretch into weeks. Second, whether insurance and freight costs keep climbing. Third, whether emergency stock releases expand beyond the IEA's coordinated 4 million barrel move. And fourth, whether oil price gains hold even after official reassurances. If those indicators keep moving in the same direction, this is becoming a durable market shift rather than a temporary scare. There are still major unknowns here. The market has stockpiles, policy tools, and some supply growth, but those defenses work best against temporary disruption, not a prolonged choke on shipping lanes. The central uncertainty is duration. If vessel flows normalize quickly, the scare can cool. If not, the economic effects become much harder to contain. The bottom line is straightforward. This is a logistics story as much as a production story. Choke points can overpower a market that looks balanced on paper. Duration will decide whether this stays volatile or turns structural.